Good evening, friends. Welcome to the pre-budget webinar held by HDFC Securities. I am Deepak Jasani here, taking you through the pre-budget expectations. Now, once again, it is budget time and there is excitement and anticipation in the air. The forthcoming Union Budget on February 1, 2018 is the first post-GST and the last full year budget of the current government before the general elections, which are scheduled to be held on or before May 2019. And hence expectations are running high about what the budget should or can deliver. The government, however, has currently limited resources or financial leeway to propose any large-scale populist measures. While the markets or a section of the markets expect the budget to be populist, considering the economic challenges, we feel that a fine reading of the provisions of the budget may display a well-balanced budget despite populist overtones. The FM has the unpopular task of balancing economic with politics, and this time the economics, that is the prolonged rural distress and a delayed recovery in growth, is shaping the politics. Now let's go into what we think will come out of the budget. The fiscal deficit for FY18 could come in at 3.4% or 3.5% versus the 3.2% which was projected at the beginning of the year. This would result in a slippage of 20 to 30 basis points due to higher divestment receipts and cutback in expenditure being offset by a fall in GST collections and lower receipts from RBI and telecom receipts. The economic survey which was released yesterday has also hinted at fiscal deficit slipping to 3.5 to 4%, inclusive of 0.5% of bank recap funds. Although the NK Singh committee report has allowed a leeway of 0.5% of the GDP in terms of deficit, the current high bond yields constrain fiscal expansion. So the FM's high hands would be tied in terms of going gung-ho into expansionary fiscal policies, which could result in higher deficit and which could result in much higher bond yields locally. The impact on the yields will be felt immediately and the deficit would be slightly back-ended. So this is something which the finance minister cannot afford at this point of time. The fiscal deficit for FY19 could be projected at 3.2% versus the initial expectation of 3%. So there again there could be a slippage of about 20 basis points. Now originally we were supposed to meet the 3% target by FY17, which has now been postponed, and ultimately maybe it will be achieved by FY20. Now, as long as the slippage for FY19 is not more than 20 or 30 basis points, and the budget arithmetic looks or seems reasonable enough to be achieved, the international investors and the RBI will not be too concerned. The RBI is expected to, the MPC, Monetary Policy Committee of the RBI, is scheduled to meet on February 6 and 7, soon after the budget presentation. A vigorous commitment to consolidation in the budget is necessary to arrest the bond market's steady climb upwards. So this is what the investors locally and globally will look forward to, whether there is a resolve or a commitment on the part of the FM and the government to stick to the stated fiscal targets, or whether they are taking too much liberties. The government should be giving signals that it will keep its purse strings tight going forward, despite this being the last year before the election. For FY19, the focus of the expenditure could be on agriculture and housing. In agriculture, we expect the government to focus on rural distress by some price support mechanism, whereby whenever the price of agri crops falls below the MSP, this mechanism will come in to support or help the farmers. CapEx focus in the budget could be on irrigation, on food supply chain, on rural roads and housing. With a large number of infrastructure projects in pipeline like Bharatmala, Sagarmala, bullet trains, housing for all, smart city, etc., we expect the budget to allocate significant amounts towards these projects. However, given the paucity of resources, it could increasingly depend on outside the budget or non-budgetary sources of funding to fund these initiatives, part of these initiatives. On the taxation front, as far as the income tax is concerned, we expect the exemption limits for individuals to be raised from 2.5 lakhs to 3 lakhs. Period of holding for long-term capital gains may be increased from 1 year to 2 years, which is in line with the immovable properties, or 3 years, which is in line with the debt funds and all. Deduction under 8I CCF, that is for investment in infra bonds, may be reintroduced in some forms to collect funds towards infrastructure development. Some plugging of loopholes like bonus stripping, etc., may also be on the annual. Now, as far as LTCG is concerned, there is a lot of debate whether it should be imposed or not imposed and what is going to be the outcome of that. One statistics is that US earns 0.7 to 1% of its GDP by way of long-term capital gains tax. Now, if we in India compare similarly, going by our current GDP, we should be raising about 1,50,000 crores every year by way of long-term capital gains, versus what we are currently collecting about 11,000 crores. Of course, US is a developed economy. There are some other economies which are emerging or developing. In some of those cases, there is no long-term capital gains tax, but this shows the potential. Now, so the point is that if we currently feel that the period of holding may be extended, but no tax may be imposed on long-term capital gains. But it is just a matter of time before that happens, maybe in a couple of years' time from now. As far as corporate taxes are concerned, we think the corporate tax rate may be cut to 25% for companies having annual sales of up to rupees 200 crores versus current limit of 50 crores. Realistically, while there is a lot of hankering for corporate tax cut across the board, a cut in across the board corporate tax rate can only be introduced with a total abolition of all exemptions that are available to corporates currently. This is necessary to achieve revenue neutrality. Now, doing away with all exemptions at this point of time may not be possible or practical, given the fact that we need to boost private capex. So that movement of across the board corporate tax rate cut will have to be postponed for a couple of years. Corporate tax rate on insurance companies may be hiked gradually from the current 12.5% plus surcharge over the next few years to bring in line with the general corporate tax rate. So this could lead to, if this happens, then this could lead to some sell-off in the insurance stocks. As far as IBC cases are concerned, the insolvency and bankruptcy cases are concerned, some clarification or legislation is expected on the treatment of tax, including carry forward, minimum alternative tax, or write backs, etc. Now, nominal GDP for FY18 could come in at 9.5 to 10% versus the originally 11.75% expected. For FY19, the nominal GDP growth may come in at 11.5%. Splitting it could be 7.3% of real GDP and 4.2% of inflation. Now, despite a cutback in the growth rates, India will still be the fastest growing economy in the world at 7.3% in the coming year. Now, FY18 GDP estimates will depend on 7.5% growth achieved in second half of this year versus 6% achieved in the first half. So how far this is possible or doable, that we will have to see. While in FY19, the growth rate of 7.3% is dependent on a sharp growth in exports in line with the rise in the global trade, a rebound in the private investment, and rise in private consumption. GST rules could be simplified and some GST rates may be lowered, although this is no longer the prerogative of the finance minister but the prerogative of a GST council. But the FM can always hint or nudge or push the council to take certain measures. So this is what can come out of it. Subsidies could be hiked mainly due to food, which is dependent on the price support mechanism which we mentioned some time back. Interest due to affordable housing scheme expansion, and fuel because of the rising cost of fuel, petrol, diesel, etc. All this may be partly offset by the gains due to direct benefit transfer in fertilizers. Further, an absence of a large one-off of like 7th pay commission payout which was in FY18 will no longer be there in FY19. So this will also help in offsetting some additional outgo due to these subsidies. Now, as far as divestment is concerned, as against the divestment target of 72,000 crores for FY18, the government may end up collecting more than 90,000 crores and may project another 80,000 crores to be collected in FY19. There are already some 36 companies lined up for the strategic divestment. Now, these companies, apart from stake sale in Suti or a sale like Bharat 22, there are some other companies which are already been identified, including Hindustan Aeronautics, a secondary sale or a follow-on public offer in Coal India, in NTPC, in General Insurance, in New India Assurance. Rail companies may come out with IPOs, so there again government will have some, will raise some money. Air India, after a lot of dilly-dallying, may finally come to the market in the coming year. Now, the government has increased the rural spending sharply over the past 3 years. Now, the average growth in expenditure over the 3 years have been 9% per annum. As against this, the rural spending has increased by an average of 16%. So there is a limit up to which the rural spending can grow from here. But anyway, we still feel that the government cannot afford to sort of ignore the rural sector or the farming sector, and will still propose a higher than proportionate increase in the rural spending. Now, India's best phase of inflation, interest rates and current account deficit is behind us. So in that sense, a lot of tailwinds are not present going forward. So this means that a growth in tax revenues, especially on the GST front, is critical to sustain the development spending in the coming year. Now, GST so far has seen a lot of hiccups initially, probably is now settling down. The last month's figure were a positive surprise in terms of growing, the December numbers being better than November numbers. Number of returns filed have also increased. So we hope that GST collections and GST filing will now stabilize, and now we will see a good growth in revenue collection from GST. Now, because that is paramount, or that is necessary to fund the development spending. Progress of IBC cases, that is insolvency and bankruptcy cases, is also needs to be tracked very closely for its positive impact on the credit discipline and unlocking of funds in the banking space. The economic survey released yesterday also recognizes that IBC and bank recap are the two levers that could restart corporate spending and infra lending. Crude prices, as you all know, have been on the rise. Every $10 increase in crude prices could cut the GDP by 20 to 30 basis points, raise the current account deficit by 40 basis points, and raise inflation by 20 to 30 basis points. So, if this continues, then it will have a lot of repercussions for the macros of the country. So, let us all hope that the crude prices either stabilize at these levels or start reversing from here. Economic survey yesterday has also highlighted that the apparel sector has immense potential to drive economic growth and increase employment in India. The rupees 6,000 crore package for the apparel sector, which was announced in June 2016, had a very favorable impact on the clothing exports, ready-made garments. So we feel that some good amount of allocation may be made towards encouraging ready-made garments exports or manufacture within the country to achieve more and more value add within the country, rather than just exporting either the cotton or cotton yarn, converted into garments and ready-made apparels. This could also have a spin-off effect on the job situation, which also needs to be addressed. The recap bonds which the government has issued or will issue will postpone achieving the 60% debt to GDP ratio target in the next 5 years. The current ratio is 69%. Now this will get again elongated or postponed. So more and more debt borrowing due to higher fiscal deficit is hence avoidable at this point of time. This is very essential so that our sovereign credit rating is protected, interest rates remain under control, inflation remains under control. The Indian market currently quoted about 19 times 12 months forward EPS, estimating about 20-21% growth in earnings in the coming year. Now this leaves a very little room for disappointment on either the earnings part or macroeconomic parameters. Over the years, the impact of budget on equity markets appears to have declined as the government has separated the policy announcements, major policy announcement out of the budget. So the impact of the budget will wean away in 1 or 2 weeks from now, and people will again start refocusing to the global events, the macroeconomic developments, and earnings. Earnings is the missing piece in the valuation game currently, so that is very important to track and to see whether they are sort of resurrecting in a big way from now. Now people keep saying that in the last budget before the election, a lot of populist measures can come out. A paper by an international organization has observed that the 3 most important factors determining the choice of both urban and rural voters in the 2014 elections were corruption, economic growth, and inflation. Now the FM will strive to promote growth while keeping inflation and fiscal discipline in mind. So this is a very, very tight rope walking. And this also rules out any big bang populism in the budget. And anyway, as far as the pre-election populist measures are concerned, we are yet about 15 months away from the next election. And this fiscal spend can come in a few months before the next election also. So they may not be announced now. They could be announced closer to the election, maybe next December or January. We could see one more round of populist measures. Now, how will the markets behave post-budget? Now, this for the current year, the markets have been rising. There was a first big rise in October 17, and the second big rise was in January 2018. We haven't seen any significant corrections so far. The index has risen about 7% in the month before the budget, resulting in the biggest pre-budget rally in almost 12 years. Further, the market volatility ahead of the budget has also been the lowest as compared to the past 10 budgets. So, having regard to all this, possibility of a large post-budget rally seems limited unless there is some unexpected big positive announcement out of the budget which nobody is able to expect or fathom at this point of time. Going by the President's address to the budget session, which also happened day before yesterday, depending on that more than the economic survey. Economic survey is just a document full of statistics. Going by what the president said, what we could look forward to in the budget is connecting all villages by road by 2019, completing the rural electrification by 2022, and other provisions to remove rural distress, including increasing the agro processing capabilities, increasing farm insurance, etc. Apart from giving price support mechanism. Another focus area in the budget could be improving the quality of education and the spread of education. There also currently a lot needs to be done and achieved. So broadly, friends, this is what we think could come out of the budget and how the markets could behave post the budget. I hope you would have benefited a little out of this. Thank you all, and let us hope for a budget which meets the requirements of the country at this point of time. Thank you.